Welcome back to Pathfinders, a podcast series from RBC Capital Markets, where we uncover the key trends and catalysts shaping the fast-moving world of biotech and healthcare. I'm your host, Joe Coletti. In today's episode, we're rebroadcasting a webinar RBC hosted with Endpoints News titled Venture Capital Velocity: What's Driving Renewed Momentum in Biotech? The conversation was moderated by RBC's Noël Brown, head of US Biotechnology Investment Banking, and includes an esteemed panel featuring Andrew Aherrera, partner at Panacea Ventures, Jeni Lee, partner at Pivotal Life Sciences, and Regina Salvat, principal at Sofinnova Investments. They'll touch on the themes that are going to continue to shape the private and public market landscape, as well as VC deal activity moving forward throughout the year. Now let's dive in.
Thank you all for joining us. Let's kick off the discussion. The Fed's dovish pivot, combined with significant M&A, has recycled capital back into the sector. It's helping drive some sector recovery. It seems that biopharma is beginning, to show some increased health across all therapeutic areas and modalities. Jeni, your firm, Pivotal Life Sciences, recently raised its second fund. Obviously, sentiment for biotech is looking more positive, and it's time to invest in new science with fresh capital. So with that backdrop, let me kick it over to you.
Yeah, sure. Thanks, Noel. It's an honor to be here and really appreciate the invitation to be on this panel here. Yeah, so our fund has certainly benefited from the significant M&A activity, that's contributed a lot to the recycling efforts underway. But I think even before that, there was quite a bit of private capital raised. So you saw a lot of these large funds close large funds, right, that are then investing into these new opportunities. I think with XBI, essentially flat since the beginning of year. Obviously there's a lot of macro tailwinds and headwinds there, but I'd say what we've been watching and kind of the broader commentary among and within our team and among folks that we talk to in the industry is really this idea of the haves and the have-nots, where you have this K-shaped recovery curve, coming out of a really inactive period, 2022 and 2023, where, you saw a lot of the companies where, they went out to raise $100 million financings, end up upsizing to 175, right? And the companies trying to raise 30 million aren't able to raise that at all. It's really this broad bifurcation, I'd say, of the two spaces and folks really chasing the companies that are really going to perform and have these really product focused and value focused milestones. And certainly that's what we're seeing. And we are focusing on making sure that we are picking the winners in the space. It's not always easy and straightforward. There's a bit of luck to that, but certainly, we are excited about new modalities and novel technologies, but there is a certain risk appetite that I'd say we're still risk on, very much so in this environment.
That's great to hear. Gina, do you have any additional thoughts or maybe any views on where we are today versus where we were last year at this time?
Definitely in Q1, the IPO activity and follow-on offerings have been higher than in 2023. I think the IPO activity is still, definitely weaker than what we've observed during the pandemic, but there's also been significant M&A deal numbers. And I think that this has led a lot of companies to really run dual track processes with their next financing. So we've seen many examples of that. I would say on the private side, we've also seen, during the pandemic, a lot of companies went to IPO very early on in their life cycle while they were still preclinical. And so it's taken some time for companies to really mature on the private side. And we're just now seeing a number of clinical stage companies with real value inflection points on the horizon that, we can invest into on the private side. So our deal flow has definitely been higher than it's been in years. And it's been a really exciting time for us on kind of the clinical side of investing.
Maybe, Andrew, you can offer some insight from the public market perspective.
Yeah, I couldn't agree with, Jeni and Regina more. I think the best way to characterize this environment is sort of recalibration as opposed to a total recovery, right? I think there's been a clear recalibration in sentiment. I think there's been a recalibration as it relates to, capital allocation and capital formation strategies, both on the part of investors and biotech companies alike. And I think there's been a recalibration in discipline, right, that kind of just went out the window during the COVID era. Conversely, I think on the subject of recalibration, where I think that has sort of lagged is in, this prevailing have and have not dichotomy, right, that we see on both the public and the private side. But, we are still very much in sort of a transition phase. But I think on the public side in particular, in the context of, the anecdotally abundant dry powder, record levels of innovation and persistent pockets of market dislocation, I think there's a lot of restrained excitement right? That certainly didn't seem to be there a year ago. 13, 14 months ago or so, right around the banking crisis. So I think it's a great time to be deploying capital. It's a great time to be raising capital, as we're seeing with some of our peers. We ourselves had raised our second fund in 2022. And as a result of our, kind of flexible mandate and exposure on the public side, particularly in commercial stage companies that we were able to own at historically phase 2 prices that, ended up getting acquired, we've already begun to return capital to our LPs. So it's a very different time from last year.
Fantastic. That's great news. I mean, to your point about the increased activity, we're seeing, Q1 having approximately like 105 offerings across, IPOs, follow-ons, pipes, RDs, all these different forms. On the VC side, though, it seems like, close to 48% of VC financings have been, sort of add-ons, insider rounds. And some VCs, some would say many, have returned to the strategy focusing on, Series B deals that are based on clinical data. So, some of the positive notes I would say of this market is the sizes of the rounds have continued to increase, and we've seen the resurgence of mega rounds this quarter. So the private financing market seems quite encouraging from that perspective. But perhaps with that setup, I could turn to you, Jeni, again, and get your thoughts on, what themes are going to continue to shape the funding landscape for these companies.
Yeah, I'd echo something that Regina said before, is really the focus on clinical stage, and then also focus on product in this market, right? There's always a dichotomy, right? Platform versus product. And certainly our fund has done both. We go early to late stage, but certainly I think in this market, right, having that focus on a clinically validated either target or mechanism or drug, right? And being able to fund that, being willing to pay more for something that has some of that validation, whether internally or from external parties. I think that certainly will continue, but it's not to say the platform opportunities won't still be well funded. I think that especially, even our platform portfolio companies, were really focused on getting those folks right to a DC or beyond. I think, coming out of COVID, there was a lot of capital, a lot of companies had raised a lot of capital, candidly at very high valuations. A lot of VCs bridged these companies, right? Did either convertible notes or extension rounds. That was very common at flat valuations. I think, with the public markets down, that is trickling in more to the privates. It always lags. And I'd say even for our portfolio companies, we've really pushed them to say, look, if you did get an extension or you were able to have a bridge financing, get further with that, right? So I think there were a lot of cuts and kind of tightenings that happened even on the private side that are now enabling those companies to get further with what they have. And so ideally they have some kind of clinical milestone to report that will really drive future financings. And we are seeing that even with our portfolio companies now.
If you were to describe what is a have and what is a have not, how would you characterize those profiles?
Yeah, I'd say it varies for the space, right, and area, of course. But as an example, if a company were to come to us and say, "Hey, look, I need 30 million to get to an IND," we'd say, "Okay, raise 40 to get the clinical data," or something like that, right? Where you really have to push further with. It's not a $50 million raise, right, to get to the clinical data. So really making sure these teams are hyper focused on that. I think the companies that were able to make that pivot a couple of years ago are certainly the haves, right, where they said, okay, we're going to really actively deprioritize, X, Y, and Z, or we say we're going to put all our eggs in this basket, deprioritize the lead, which is an IO, and then, push forward something that all strategics are really focused on. And so I think there is to Andrew's point, a recalibration, right, where it's, okay, yes, there is this idea of chasing hot targets, but at the same time, making sure that those are viable, of interest to strategics. You have a way out, so to speak, of can I license this out? Can I enable a partnership or an M&A deal with the funds that I have today?
Got it. No, I appreciate that. Andrew, how do you see this?
Well, actually, I mean, on the subject of mega rounds, I thought that was an interesting point, right? Where I think that it's probably worth, establishing the devil's in the details there, where, just as with the XBI resurgence, right? I mean, somewhat belied by the wider return dispersions that we're seeing across different market cap segments. I think these mega rounds that we're seeing of late on the private side are really quite different from those of the COVID era, right? In that they're arguably more reflective of, I think, investors being more thoughtful around right-sized capitalization and having an eye towards, really ensuring runway to a real meaningful value inflection point, right? And so just because the headline number falls into, mega round territory, doesn't mean that investors are back to writing checks indiscriminately, right? I mean, if you look at these companies, these are either really robust platform companies with tremendous breadth and potential, or companies with a pipeline of later stage assets that require that quantum of capital, right, in order to fund the requisite phase 2 or phase 3 clinical programs that, if positive, could then justify the step-ups commensurate with the degree of de-risking afforded by those expensive later stage trials. So I think that's an important distinction to make, right, where it also nonetheless is still quite encouraging, right, to see all these rounds come together and the syndication that's formed around these companies, where it'll be interesting to see, in the next 12 to 18 months or so, ultimately what their trajectory is, right? As far as how concordant that may or may not be with some of the, mega rounds that we had seen, during the 2020 and 2021 period.
I was just going to add, I think a lot of those mega rounds you're seeing as well are underpinned by tremendous teams. And so when we think about kind of the haves, as we would classify them, right, certainly having money is great, having a great syndicate is fantastic as well, but it really is speaking to the caliber of the teams that are founding these companies, right? You do put a lot of trust in the execution ability here. So I'd say that's definitely something that we keep an eye on as well.
Yeah, and maybe also to add, I mean, I think there are two underlying themes that are also leading to some of these mega rounds, right? Pharma has to really fill huge revenue gaps, and they're moving towards larger and larger indications. I think also partially driven by some of the IRA policies. And so we're starting to fund larger and larger indications on the venture side as well. I think obesity is a great example of that, where you need a lot of capital to get to some of these inflection points. And to Andrew's points, they are funding pretty large clinical trials in order to get to data readouts that require a lot more capital.
That's an exciting point, Regina, because, we came out of an era not too recently where we were focusing on increasingly high levels of precision, which is great for getting at really tiny populations that, in certain rare diseases or rare cancers where people just weren't spending to get results in. But ultimately, even at high pricing for those therapies, they're smaller markets, right? And now things have sort of turned, this wave being led largely by obesity, no pun intended, but other therapeutic areas benefiting, cardiovascular, CNS. I mean, we're seeing companies being funded for indications where historically, 15 years ago, I would, get doors slammed in my face. So it's an exciting time from that perspective. One thing we're seeing a lot of is these pipe-driven sort of wall-cross deals that are happening. And what's fascinating from the banker perspective is in certain cases, we're hearing a bit of blowback from investors, particularly those that are unable to participate because they don't they don't wall cross. And so they didn't hear about the deal. Andrew, you're probably seeing this a lot more, but what's your sentiment around this type of deal?
First of all, I think that in the context of all of the deal flow that we've seen in the first quarter, right, I think it speaks to both the recovering health of the sector, as well as some of the hallmarks of, I'd say potential implications of this investing paradigm shift that we've seen play out over the past 2 years, right, where there's clearly been a flight to safety and a flight to quality, right? And so I guess on an overwhelmingly positive note, the fact that a large proportion of the recent deal flow is tied to M&A recycling, I think tells you at the very least that the drug development functions of the sector are doing just fine, right? Great companies with real drugs that benefit patients get acquired for significant premiums. That's what the sector is designed to do. What's interesting to me, though, is that even though it's unsurprising that the nearly 20 billion or so, right, of capital raised in the first quarter was heavily skewed towards existing portfolio companies of large specialists that arguably are already well capitalized to begin with, and for the most part do represent a later stage phenotype. I think it will be really interesting to see how the balance of the 100+ billion or so in aggregate 2023 M&A winnings gets put to work in the second half of the year, and in particular how much of it, if any, makes its way to these have-nots, right, or a third or so of the publicly traded biotechs that have less than a year of cash. But that said, to answer your question more directly, I think we all know what's driving a lot of the deal flow that we've seen. So the bigger implication is, what happens to some of these other companies that fall into that have-not camp, whose stock price trajectories may otherwise be misleading as far as the kind of value that they have to offer, right? So I think that should be kind of the biggest takeaway there for me.
Interesting. In Q1, 56% of private financings have been focused on clinical stage companies. And for you on the private side, what's the source of the deal flow that you're seeing?
I think I mentioned earlier, it's been really robust. We've seen a high level of, really quality companies that have been coming to us over the last 6 to 12 months in the clinic. And I just want to make one distinction and one note. I know there has been this shift towards looking at clinical asset-driven deals, but at Sofinnova, we have historically always kind of been in that realm. So we invest about 70% in clinical stage opportunities across multiple funds, and we're really set up to help companies in that realm. So we have a large number of investment professionals with a combined 120 years of operating experience and really focus on providing clinical and regulatory insights with our executive partners to help companies get to the market. And so that's led on our end to 27 FDA approvals that we've helped support and a 4.3x higher clinical success rate than the industry average within our portfolio. And so I think that's really what's been driving our success in this market. It's just our expertise on the clinical side. But I would say right now, there's just been so many clinical stage companies on the private side, again, as I mentioned, that have value inflections in the near term that are really setting themselves up for the right financing to get them through the right clinical readouts, that it's been an exciting time on the private side.
As you think about these companies sort of maturing and then getting to be IPO candidates, we saw a lot of preclinical companies that did an IPO. I think you were talking about that at one point, and now those companies have matured. Any other thoughts on, that deal flow translating to the IPO market? Any commentary on syndicates?
Yeah, I think one theme we've seen is that high quality companies with, again, great drugs are willing to take down rounds in this market in order to build the right crossover syndicate. And I think that for some of these companies, that's a really great path for them because they build the right crossover syndicate and they're moving towards an IPO when the timing is right for them with the right crossover syndicate to support their IPO, which is important in this market. So that's one theme we've seen. And again, I mentioned, I think already, we've also seen a number of dual track processes where as companies are raising on the private side or public side, they're also running an M&A process, right? And we've seen just so much M&A activity. And I can think of a couple of examples where that process has really worked successfully for a few companies.
Andy, what do you think is the gating item with these IPOs? You've only seen a single digit number of them. Does it tie into what Regina's talking about with the M&A market? Is it because these dual tracks have been so successful on the sales side that there aren't good companies to go IPO? Or is it more of a demand issue in that investors aren't clamoring for IPOs?
Yeah, how much time do we have? I mean, I think it's both self-interest and specifically a fundamental misalignment between corporate and investor self-interest. And then there's pattern recognition that comes into play, right? Where, I think that's important to emphasize because while a lot of us, really understand the corporate mindset, the reverse isn't necessarily true, right? Especially on the part of first-time management teams that we've seen a proliferation of over the past few years. And I think two things that, these management teams seem to be, at least in my view, putting, say, less importance on, if not totally ignore, are one, the importance of right-sized capitalization, right? Just because there's more money available to you than you need doesn't mean you should take it. And two, how critical positive aftermarket performance is, especially after lockup expiry. And, our view is that this has just as much to do with the ability to attract and retain high quality talent as it does in attracting and retaining high quality investors, right? Because if your stock works, not only do you typically get a pile-on effect, as we've seen with some of the more successful IPOs in the past 2 years, but more importantly, the financial incentives become aligned, right, for all shareholders of the company, which include its employees. So at that point, everybody from the bench to the boardroom are now just betting on the company based on science, and they can do what they do best in their respective functions without having to worry about their financial situation. And this is kind of where, pattern recognition takes over, where, the bottom line is that there needs to be opportunity for return generation to justify supporting these deals, right, over the long term. Now, that said, I think, building a book is certainly an art form, right, and kind of a delicate balance to achieve. But at the very least, any book that is truly oversubscribed, right, with real orders, shouldn't break. I mean, let alone the first out, right? But I think the point is that any management team or board that isn't thinking in this way is bound to wind up with a broken deal and is doing a company and its employees a disservice in the same way that, we as investors will be doing our LPs a disservice if we returned anything less than a 1x DPI, right? There's never a promise of returns, but I think thoughtfulness around not losing money should be much more front and center. Because if you then zoom out, right, from the individual company level, I think the more these deals keep breaking, especially those that break earlier on, the kinds that trigger deep-seated buyer's remorse, especially for, new long-term investors who come in, really buy into the story, the harder it becomes to entice generalists back, into the space. And we'll continue to keep specialists focused on supporting their existing portfolio companies and thereby keeping the IPO window narrow, right? And exacerbating the this prevailing have and have not dynamic on both the public and the private side.
What I will say is you covered about 4 different topics for future webinars with that answer. But one thing I want to make sure was clear for folks, this concept of these deals breaking when Andrew's talking about having 10x demand, it's, when you put into numbers, these are companies that are looking to raise $100 million that are ending up with $1 billion of what we believe is real demand to be in the order book. And despite having that much demand, these companies are breaking issue, i.e. they trade down below their issue price. And it is baffling because, again, if something is in such demand, right, these prices should stay up. But then it begs the question of, is the stock being put into the right hands if it's getting sold off, right? Like, doesn't that mean there's an allocation issue? You have to be very specific about the lender, right? Because, again, you feel somewhat removed in the context of an order book, but ultimately these are investors you're going to be interacting with probably on a weekly basis, right? And so you want them to be, again, a positive force in your shareholder list, in your shareholder registers. Regina, is there anything else you would add just about the IPO market?
One question that has come up that I don't think we've directly addressed is just kind of what are the themes around what are people getting excited about from a TA perspective? And I would say, our firm has really benefited from some of the M&A activity as of late. I think you were probably referring to Aeolus in terms of the companies that barely saw the light of day. That was in the I&I space, but we've also had some wins in radiopharma with Raise Bio, where we led the last private round, and Karuna as well, which I think we shared with Jeni. But some areas we've seen a lot of excitement in lately is ADCs, additional radiopharm, obesity, and CNS, I think, is the newest area where we've seen a lot of activity. I&I continues to be of interest with a lot of companies in the bispecific space within radiopharm and still a lot of rare disease activity as well, where we see clinical data from rare disease companies that's really compelling and exciting for patients. So those are some of the areas of many that we're excited about, either making an investment in or where we've recently made an investment that, really ties to our strategies.
So perhaps we can talk a little bit about this M&A activity that all of you have frankly pointed to. That market continues to rally, right? And we've also seen very robust partnering deals established, a lot of strategic collaboration. The ADC space has seen a tremendous amount of activity. Seems like everybody has to have a foothold there. Radiopharma, both alpha and beta emitters have had, have garnered a lot of pharma attention. There still seems to be pharma players that have not yet made their move in radiopharm. Eli Lilly recently acquired a French antibody drug developer, Mablanc. So maybe, Jeni, you can offer some thoughts on, we all know that pharma has been on this acquisition tear for the last little while to try and replace a lot of the patent expiration product exposure that's happening. And, Pivotal, through its investments, has been a beneficiary of some of that M&A interest. And so another question directed at you is, how do you see this kind of pharma-led deal activity continuing to impact the space?
Yeah, I mean, it's hugely impactful, right? And certainly it's a way for us to recycle and return capital to our LPs. We were major beneficiaries kind of end of year into the beginning of year with Karuna, Fusion, and Gracell. And I'd say it's interesting, right? Because Karuna very much so is that kind of fill the gap of pharma. Fusion and Gracell less so, right? Those were earlier stage companies, or at least earlier in their clinical development. When we look at these companies on the private side, obviously it's a little harder to plan for an M&A. You want obviously the strategics to be there, and we make sure that each company that we invest in has a list of strategics, but you never really know, right? Like what the appetite is. And And I recall we had done actually some diligence on one of the acquisitions where we talked to the head of BD who said, nope, that's not something that we're going to look at. And then lo and behold, 6 months later, it happened. So, you never know what changes at some of these pharma. So it's just more difficult to plan around the M&A. Obviously, we then, pushed up companies towards an IPO, but certainly the M&A path is a really viable one to consider. We do have the flexibility to invest across the pipeline. So we try to pick winners in these hot spaces. I will say something that's been interesting as we've seen, right? So Karuna obviously went well for us. We're also investors in a company called MapLight. The idea of kind of these spaces heating up, right? Cerevel preceded Karuna. And so you see these spaces heating up, but you have to have gotten in them, right, earlier. Certainly you can buy them publicly, but the real return is having invested, I think, privately, or at least as early as you can. And so as we landscape and survey some of these heating up spaces, I'd say it's still tough to pick the winner. I think, you have to be good, but you also have to be a little bit lucky in these spaces. And it's hard to tell often preclinically what is going to make, company X versus company Y a winner, especially as there's been, as an example, right, a mass pivot of a lot of the CAR T companies into autoimmune. When we look at those, everyone kind of references the same data and we're like, okay, sure. But, I don't know how preclinically you're going to be able to show me that you're better and whether that's going to pan out clinically. So I think there's an interesting dynamic as well of kind of the me too's and the acquisitions as opposed to the truly innovative where, we kind of have a bifurcated strategy, at least when we invest, is we do go super early. We do company builds, company formations, but we try to be really thoughtful. Like, if there's a total novel target in a really hard area, that's probably not great. You see in neuropsych, as an example, it's a lot of around the same targets, around the same ideas that are actually really successful. And we know that those are going to move the needle because, right, clinically you can demonstrate the benefit. And there is a lot of already belief that biology is well validated, understood, and that removes a ton of the risk when, downstream you may have commercial risk to deal with. And so I think for us, it's hyper important to have the M&A track. I do think that M&A companies have a little bit of a different flavor and profile than IPO-able companies.
I will add, though, to Regina's point earlier about dual tracking. I mean, just over the past 2 days alone, right, there seems to be a bid out there to buy private companies, which I think in this environment makes total sense, especially in the context of if you look on the public side where you've got a little bit of crowding, right, going on at some of the, top SMID targets who are also themselves flush with cash, as well on the sort of opposite side, just persistent dislocation among some of the potentially interesting smaller or micro cap targets, right, that pharma would be very unlikely to offer up, these whatever 10x plus premiums, right, or whatever that relatively larger spread those companies' boards may believe gets them the fair value. But for some of these interesting private companies, I think there's fewer investors to worry about. I mean, each of whom could potentially get a great return on an upfront, coupled with risk shared additional upside downstream that really makes for a good setup. So running a real process in parallel with any financing is quite prudent these days, especially for those facing the proverbial existential crises, if you will, to help them maximize optionality.
I mean, you make a great point, right? I mean, one of the big benefits of companies selling while private is, and you sort of demonstrated this, is the difficulty in benchmarking how much you're actually paying for it as acquirer, right? And in a way, I would think it almost reduces anxiety because there isn't a publicly, listed and known premium that you're paying that you then have to go justify to your boss, because everybody's got a boss, right? With private companies, the price is kind of what you've negotiated it, and often is a reflection of what seller is demanding and what you're willing and stomaching to pay, right? So there's almost, as an advisor, I sometimes see there being a little more freedom for those deals to get done. But part of the holdback on privates historically has been it took a long time for that market to sort of rationalize and kind of recalibrate relative to the public market. So we saw a lot of the publics getting taken out because, their prices quickly adjusted, and a slowdown on the private side and sort of recalibrating valuation. What's fascinating now, though, is, again, to the point Jeni was making, if you're thinking about neuropsych, those companies have gotten huge, right? And if you think about something like ITCI, having tremendous commercial success as well, driving valuation. These are pretty big bets. I all think very good bets, but larger. And so then going earlier is, hopefully you can kind of catch fire before it really becomes a towering inferno of cost. And Regina, we should get some color from you because I know you guys have witnessed the same trends. You're benefiting from the same things. It'd be good to hear your thoughts.
Yeah, no, I agree with everything that's been said here. And I would just say on the CNS side, definitely seeing renewed interest in that space, which is really exciting for patients. And, we've made several recent investments in this space where oftentimes the pipeline of products that the company is developing is a mix of de-risk targets, typically as a lead, and then getting into the more novel space with earlier stage pipeline agents. So, hoping to bring some innovation into the CNS.
I think we covered a lot on the M&A topic, but maybe we could talk just about some of the stuff you all touched on earlier about where there's going to be continued innovation.
So at least for Pivotal, we do quite a few landscapes internally. So we keep tabs on kind of spaces as they evolve, as they emerge. We try to track, for instance, regulatory updates and maybe changes in regulatory views that may be a huge tailwind to an area. For example, osteoporosis is a space that we historically would never have touched. Yet FDA next year is considering, right, making fracture basically not the primary endpoint, right? And if you can use bone mineral density instead, right, you have basically a biomarker or an earlier readout that suddenly makes a phase 3 trial tenable, right? In quotes from a VC fundable perspective. I think this very much goes to Regina's point around moving towards larger and larger indications. We're certainly doing that as well. But as you kind of enter into those sectors, right, like we've done or tried to do deep dives around CV Met, those are huge spaces that have a ton of heterogeneity that may not actually be understood from a patient even perspective, right? And so you do require then either big pharma or foundations to run these natural history studies and just have a better understanding of the disease. There's a lot of questions around orphan interest. Certainly we're still interested in an orphan, but it is important for us, if you go after an orphan indication that's very, very well defined, enough is understood about that population. And if it's a gateway to a larger indication, we see some of the pulmonary hypertensions, for instance, right? It's a gateway into a much broader indication, but that then presents larger risks as well if the patient population is too heterogeneous or you don't have a good understanding of the clinical endpoints that are required. That keeps us a bit on the sidelines, but certainly ones and areas that we continue to explore. So I think CV has been a big one for us. Everyone talks about I&I and immunology. That's certainly a next wave and quite hot. But I think that there are, right, you can segment down those broader areas into very specific smaller indications, larger indications. We recently started talking about IBD again, right? So these are all things that I think come in cycles where, you kind of bring them back and you circle back and say, hey, has anything changed? Do we understand more about the disease, or is regulatory appetite improved? Then it becomes kind of more top priority for us.
In our industry, the sort of creative destruction phenomenon is just, it's pervasive, right? So for us, the companies that we look at when it comes to, having real products, I think is the ability to maintain what we perceive to be, their disruptive capacity, right, of the current treatment paradigm with continuity and duration. Whether that's, by virtue of first mover advantage, that's likely to make it, somewhat entrenched across multiple large indications, a la Dupixent, for example, or just best in class therapeutic index that just blows the competition away, even if not first to market, right? Akin to, say, Carvykti, for instance, right? Or some other, I guess, differentiating quality that is tied to, convenience, cost, or even just non-genericizability. Right, or some combination thereof, the latter which tied to perhaps radiopharmaceuticals, for instance.
Those are great points, Andrew. And I would say two modalities that I've been spending a lot of time thinking about what kind of is the next wave of innovation in. I think for radiopharm, we're still really early days, and there are ways to really improve upon the supply chain, waste management, things like that, where, novel radioligands and novel targets, I think, are really going to open the field up in the future. And also for cell therapy, I think, we've made a lot of waves in cell therapy, but still it's a pretty complex CMC and commercial scale up area and modality. And, we've been spending a lot of time thinking about how do we get cell therapy to the masses and what technologies are really going to enable that. So, whether it be in situ CAR T, T-cell engagers, some other modality that hasn't invented itself yet. So it's a space we've been really thinking through and making some select investments in already.
That's all the time we have for today. I want to thank the audience for tuning in. Thank you to our panel. We really appreciate you guys participating here. I'm Noël Brown from RBC Capital Markets. Thank you for joining us.
Thanks again for listening to Pathfinders in Biopharma, brought to you by RBC Capital Markets. Remember to subscribe to get more great content and be alerted about future episodes. This episode was recorded on May 29th, 2024. If you'd like to learn more or continue the conversation, please visit rbccm.com/biopharma. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.